Welcome to STRAT This Week. I'm Will Woodall, Mike Rarey, the week of April 10th, after that spectacular Masters yesterday. Did you watch?
Of course.
Quite the performance by Mr. Rambo. And not a great performance by Brooks Koepka.
That's right.
He looked like the bond market, and Rahm looked like the equity market. Maybe we'll dig into that in a little bit.
Over what time period?
Let's look at the returns from last week. It was an interesting week. The volume was very, very low, just across the board. So let's talk about the equity markets first for the week.
Yeah, only 4 days of equity trading, and the only thing that really stuck out was the energy sector posting gains. That's why you'll see large value last week slightly positive. Pretty much every other area of the equity market negative. And of course, energy companies rallying because crude oil prices were up, 6 to 7% last week, following the OPEC plus production cuts, which were announced last weekend. So that was really the only bright spot in terms of equities. Not a lot of trading, not a lot of volatility, not a whole lot going on except for energy.
Yeah, it's hard to get a read when there's not a lot of volume on what sentiment is. But in the fixed income market, things were a little positive.
Yeah, and we know that there's generally less liquidity in the U.S. Treasury market than, a year ago, for example, and we know there was also light trading. So the moves that we saw last week in fixed income with yields coming down across the curve, we also saw credit spreads hanging in there reasonably well. You'd probably take that with a grain of salt as well. I mean, the fixed income market reacted to some key economic data points. And so directionally, we think these moves make sense. It's just tough given the lack of liquidity and lack of trading to say is the magnitude appropriate. But yeah, really weak ISM services data. ISM manufacturing data was really weak. And the prices paid component in ISM services coming down quite a bit. So that does good things for expectations of inflation.
So what do we make of, to the earlier point I made about the Brooks and Rahm.
Brooks and Rahm, yeah.
What do we make of the bond market sort of signaling things aren't great right now? The equity market's kind of saying, well, maybe they are fine.
Yeah. Well, and this will probably tie into liquidity. You could see why some areas in the equity market, particularly growth areas, have rallied year to date, because if you just look at Fed assets, they've come up. Okay, I want to trade growth stocks, so on and so forth. But if this were a true liquidity pivot by the Fed, something to get excited about, we wouldn't see bond yields coming down this much. The bond yield is definitely signaling that, hey, liquidity may have come up the last few weeks, but for the wrong reasons.
Right.
And that economic data is still losing momentum, which we're definitely seeing.
Right. Yeah. So let's turn to the alts. You mentioned energy.
Yep. Yeah, energy up last week. Crude oil prices up because of OPEC plus, but more importantly, year to date, you look at the energy component of commodities down quite a bit, but gasoline prices, which of course are what drives sentiment and has a big impact on economic growth, those are actually up 30% year to date. So that's going to start filtering into the inflation numbers. And then other notable things within commodities, you saw a continuation of this trend we've seen year to date with industrial metals down, signaling potentially a loss of or slowing economic momentum globally, with precious metals up, signaling the exact same thing.
And how does the Fed look at something like gasoline prices and say, all right, we need to continue to hike, or this is just transitory, we can pump the brakes here?
Well, they've stopped using the word transitory, that's for sure. They retired that one from their vernacular. But we'll see when we get into the inflation figures. It just reinforces this trilemma they're in. It just shows, they need to do more work to defeat inflation, but that is directly at odds with maintaining financial stability and avoiding a recession. And they kind of have to pick one.
Yeah, absolutely. Yeah. Let's turn to another chart here, deposit migration. And first, let's explain what this is and what we mean by deposit migration. So this is a bank chart looking at bank deposits.
Yeah, in last week's video, we sort of waxed poetic about how deposit migration is creating financial instability and is going to definitely hamper credit creation going forward. And so we wanted, so what does deposit migration? Show it in a chart. Well, it's more lines than this, but if we were to summarize it, this is basically what's happening. The red line is deposits at small banks. And we're showing the 4-week change of these numbers. So you see the red line is down almost $300 billion in the past 4 weeks. So $300 billion worth of deposits were pulled out of smaller banks. And where's that money going? Well, we know Silicon Valley. They actually weren't a small bank. They were a medium-sized, larger bank. So they're not even in here. But where's that money going? Well, it's going into big banks. That line not shown here, but we're going to hear from them. Earnings. They're going to report earnings starting Friday, so we'll hear how much they got. It's also going into money market funds, which that's where the credit cycle really sort of takes a body blow. Because what you're doing is you're taking deposits out of small banks, which do a tremendous amount of lending to the real economy. Commercial real estate, small business loans, et cetera. So you're reducing the amount of money they have to lend out. And then where is that money going? Well, it's going into a money market fund. And then what's that money market fund doing with it? Well, they're parking it at the Fed. And so all of this liquidity in the economy, it's ending up right back on the Fed's doorstep. It's like, oh, no, thanks. We don't need this money. We don't want this liquidity. Take it out of circulation.
Right.
And so it's bad for liquidity. Which is something that matters, and it's bad for small banks, and it's bad for credit creation going forward. And
so the knock-on effects of this. So it's bad for the small banks, which means in turn they're going to lend less. How does that play itself out through the economy? What's the time horizon for the economy to recognize that credit tightening or credit crisis that potentially could occur? Yeah.
Well, we're already seeing it in terms of financial conditions, which we'll speak to a little later on. But then, if this continues, this migration continues, thankfully it's slowed here in the last week or so, but the fundamentals at play suggest it should continue. If it continues, then, you have a tremendous amount of commercial real estate loans coming due by the end of the year, and it'll be maturity walls where you really see this flare up, right? It's not a big deal if you're a small business if you have a loan outstanding, but when it's time to, I was going to refinance that loan, I was going to get a new line of credit, I was going to, get a new commercial real estate loan. Whenever that comes due, it's going to be really tough.
Right.
You might not get the loan, and so there are implications there, or if you do, it's going to be very expensive, which also has problems.
That's the key.
Yeah.
Okay, so let's take a look at liquidity and changes here.
Continuing to see low and rising. I mean, the only real update from last week is we've reduced the pace at which we assume banks are going to be using the Fed's new bank term funding program. Previously, we were expecting about $160 billion worth of usage a month. We've cut that in half just because the usage has slowed here, particularly last week. And we'll continue to update. I mean, we'll get more data this week and we'll adjust the pace if necessary, but still nothing to get excited about, even with the $400 billion increase in Fed assets, primarily from loans. You're still in a very low liquidity environment, negative for the rest of this year.
Right.
Yeah.
And so let's translate that to the net liquidity figures, and we've added a dashed line here to sort of X out the loan factor.
Yeah, and we spoke to that solid green line quite a few times in previous video shoots. You see it jump up there and imply that, all right, well, the S&P 500 is about at liquidity implied fair value. But that jump up in the solid green line is due to those loans.
Right.
Loans to the bridge banks for Silicon Valley and Signature, the FDIC established bridge banks, loans in terms of the bank term funding program. Those are not things to get excited about. So if you were to take out the loans, that's where you have the dashed green line. That's something more like 3,700 is the liquidity implied fair value, which we think this time around, given these circumstances, is probably a more realistic figure.
Yeah. All right, so let's. You mentioned economic surprises and financial conditions. Since the bank's crisis started, we've seen a rapid deterioration in the financial conditions. Is that solely because of the banking crisis, or are there other factors involved here? And what happens with this type of deceleration?
Yeah, it's a few things. I mean, you recall February, the whole narrative in February was the Fed needs to hike the Fed funds rate to 5.5%. And we saw interest rates rising throughout February. When interest rates broadly rise, that tightens financial conditions. So that was the start. And then mid-March, the banking crisis happened, and that really slowed the credit markets. It pretty much stalled out the leveraged loan market. There wasn't a lot of new bond issuance. Everything was sort of put on pause. The dollar started to strengthen, credit spreads starting to widen. And then even though the Fed did everything they did in terms of trying to stop the banking crisis, and they've largely plugged the hole, I guess, stopped the leak.
Yeah.
Financial conditions just kept getting tighter. The blue line just kept going down. And so you see the implications that has for economic momentum. As a proxy for economic momentum, we show the Citi Economic Surprise Index. When financial conditions tighten, the economy loses steam. And it happens very quickly, very quickly. So this is going to be, you start to think about the Fed meeting in May, and let's start hyping it up right now, right? Because why not? But they're going to be dealing with inflation, which we're going to talk about, still not showing much progress, particularly because gasoline prices are rising. This deposit migration, which is continuing to have implications for financial conditions and economic growth, and what are they to do, right?
I mean, you had used car prices rise again.
Yeah. So what are you going to do if you're the Fed? I mean, you have to choose one. You can't do it all.
Right.
The market likes to think the Fed can do it all. They can defeat inflation and maintain financial stability and avoid a recession. If we've learned anything from past cycles, monetary-induced inflationary cycles, the Fed really only has one choice, and it's defeat inflation. And it's going to come at the expense of financial stability in the economy.
And so, given that, and now we're entering earnings season, how does that translate into, earnings were okay last quarter, but they were still down. Their projected estimates are coming down rapidly. How off could we be?
Yeah, you could be pretty off. I mean, if we're once again, we're in an environment where our recession indicator is elevated. So if you go into an earnings recession and there's a follow through in terms of an economic recession, analysts are way off, way off when it comes to predicting earnings in those type of macroeconomic environments. So could be way off. Yeah.
I mean, we just saw data today from Apple on their computer sales being off 40%.
40% down, 40% year over year.
Yeah. Which it was coming off a very high number.
Right.
But that's a big drop. Also, in the last week, we've had quite a deceleration in the Q1 GDP now forecast, going from almost 3.5 to 1.5 in a very quick manner. So let's walk us through what occurred here and why the rapid deceleration.
Yeah, and that dark blue line is the Atlanta Fed's GDP now forecast, how they were tracking what the Q1 GDP number is going to be most likely when it's actually reported at the end of April. And you see in the last month or so a pretty significant rate of change. You got as high as 3.5% and now down to something more like 1.5%. And that's just more rational. I mean, it's just more logical. The 3.5 number was higher than anyone expected. It was very Goldilocks. You see at the beginning of the quarter, the fundamentals were suggesting something below 1% was appropriate for Q1. And what's done the majority of the sort of decelerating here in terms of the estimate has been consumer spending. And that primarily came through in the ISM services PMI last week in particular, where, ISM services were absolutely lights out. And we know the services spending side is where a lot of the consumer spending was happening. And so to see it slow that much in March, that really sort of lopped the froth off of this GDP number.
Yeah, it'll be interesting to see. I think we get retail sales also this week. So
Friday.
Interesting to see how that comes out after this rapid decrease here. So,
so now we're at 1.5, and this far out from the actual release, the variance is somewhere around 0.5% to 1%. So it still could be 2. I mean, it still could be less than 1. We'll see.
All right, so let's move on to inflation. Seems like every time we look at this, the forecast continues to stay elevated.
Yep. Then, not a whole lot of progress here. Wednesday, we get the March CPI numbers, which are not expecting to show a tremendous deceleration. I mean, headline CPI should continue to come down on a year-over-year basis because primarily of the base effects. Some really hot numbers 12 months ago are falling out.
Right.
So that's helpful. But then if you think about early expectations for April, headline should actually come back up slightly because of what we're seeing in commodities, particularly gasoline, and how those flow through to headline.
Right.
And then on the core side, prices paid for the ISM manufacturing and services, those help somewhat, but over time, higher energy costs feed through to core as well, not directly, indirectly, and implicitly through other costs. And then you still have things like shelter and services ex shelter, which aren't really coming down. So once again, hyping up the May Fed meeting. They're just still going to be in a really difficult spot.
I mean, the evidence continues to point towards a 25 basis point hike.
Yeah.
That there's no reason for them to not continue to raise interest rates until they've made progress here.
Yep.
And it's a long way off.
Yep.
So that, unfortunately, translates into recession. And our recession indicator update for the week.
Yep, just a slight tick higher. I mean, it's still elevated. Really, the only reason why we saw a slight tick higher is one of the good things in terms of the longer term indicators was crude oil prices had come down year over year. Because you think about where we were last year, this was post-Russia invading Ukraine, crude oil prices were very elevated, so they'd come down year over year. And now that was a positive, and now it's just less positive.
Right.
Because those base effects are getting less favorable, and crude oil prices are coming up here in the near term. So,
and in terms of the recession, so our models sort of look at a probability of recession somewhere, if it's going to happen, starting somewhere in the next 5 months, right?
Yeah.
And so, take us through if the model plays out as it is, when does the market sort of start to react to that?
So in past cycles, the market has actually been near or even making all-time highs or 52-week highs up until about a month or two before the actual recession date. So, everybody wants to talk about how the market's efficient and rational and takes into account all future information, but time and time again, we see, the market running at highs right into past recessions. So, anybody who's saying, oh, there's clearly low recession risk because, look, the S&P 500 is at 4,000, we would say, well, that means absolutely nothing in terms of predicting recession.
Right. And then just one last area to cover. So in terms of earnings season coming up, what are the things that we would be listening for during sort of the earnings releases that would tell us how things are trending?
Yeah. The big story is coming into this quarter was companies that were able to push through price increases. The market rewarded them, and they were sort of forgiven on volume. It was just, hey, can you push through price? I want to see you push through price increases. I don't want to see you ramping up production or volume or anything like that. And that sort of kept the market afloat, I guess you could say. But this quarter, if that narrative starts to change and it's, hey, we can't push through price increases anymore. On face value, you say, oh, well, that's great for inflation. But the question is, why can't you push through price increases anymore? Because eventually the consumer says, hey, I'm out of money. I've maxed out my credit cards. I've taken on too much credit. I can't afford these higher prices. I can't do it anymore.
Right.
And that would be bad news. That would be bad news. That narrative shift, along with a continuation of hearing about the layoffs, hearing about job cuts, that would be bad news.
And we haven't really touched on the job market, but we're starting to see small signs that the job market's rolling over. I
mean, the March payroll number was just fine. It's obviously lower than prior months, but there's nothing in that report that would suggest any type of meaningful slowing in the labor market. But once again, if you were to just look at non-farm payrolls, how they how they progress right up to past recession dates, the fact that we're adding 230-some thousand jobs a month, and you'd say, hey, that's evidence we're not going into recession. That's the wrong way to look at it. That's evidence we weren't in recession,
Right.
or we're not currently in recession, but it means next to nothing in terms of will we be in recession in the next 3-6
Right.
months.
Yeah, very good point. Great. Well, I think that's it for this week. If you have any questions, reach out to us. And we appreciate you tuning in, and have a great week.